what we do is we take $1 of the exposure and we make sure that that gives you 100% exposure to the US equity markets. And then on top of that, we stack both gold and Bitcoin. And we, again, use futures and ETFs to stack that on top. And what we do there is we don't want the maniacs running the asylum. So if we had equal dollars of Bitcoin and gold, well, Bitcoin would be fluctuating a lot more than gold. So what we do is we equal risk weight those two assets, gold and Bitcoin. What that turns out to be is about 80% gold and 20% Bitcoin. And now in the portfolio, you have your US stocks as your base. Stacked upon that is your exposure to both gold and Bitcoin. It gives you this diversifying impact between actually gold and Bitcoin because they are a little bit non-correlated. And again, you're getting that exposure to this asset that has these asymmetric return potentials, but not too much so that you can stick with it and have it in the portfolio when it's adding a lot of value. Let's say you wanted to have a 2% position in Bitcoin and an 8% position in gold, but you didn't want to sell your stocks in order to achieve that. So you'd sell 10% of your exposure to the US equity market, and then you would buy in its place a 10% position in RSSX. That would give you back that 10% in S&P stocks. Stacked upon that, you'd have 8% exposure to gold and 2% exposure to Bitcoin, which to me is a very responsible way to add both gold and Bitcoin to your portfolio and also reduce that line item risk. So, you're not going to see this crazy Bitcoin going up and down or have clients potentially asking about what's this line item, what's that line item. And that way we can also take advantage of the rebalancing that can occur when one asset is going up and the other asset's going down, and you just rebalance those back to your target weights. And that balance in the equal risk sense is also something that fluctuates. It moves as the volatilities of gold and Bitcoin move. So we look back over 500 days and we say, well, what's been the volatility of Bitcoin? What's been the volatility of gold? The last 500 days, it turns out it's about 4 times more volatile. And as that changes over time, then your portfolio will reflect that change in volatility over the medium term. It's rebalanced regularly, but we do a band of rebalance because assets can be a bit volatile. What we say is there's about a 10% range. When one asset's doing well, you let it drift a little bit. It also reduces the trading costs and things like that. So it makes for we think, a superior implementation. You don't have to do that every day. You just need to sort of move that when you've had a deviation from your original portfolio that makes sense to do so.